Hello and welcome to another video on accounting. In this video we are going to discuss accounting for partnership. This is the first video in a series of video on accounting for partnership, so do watch other videos for more information on partnership. In this video we are going to discuss and understand what partnership is and explain the differences between different types of partnerships. Now to explain what a partnership is, we are going to use the example of Muskan and Kathy, who both want to work for themselves. Their friend Brian suggests that they should start a partnership. Now Muskan and Kathy want to know what a partnership is. So Brian explains that a partnership is a relationship between two or more persons carrying on a business for a profit. The important thing in the definition is that it's a relationship between persons. Now, the persons are normally individuals, such as Kathy and Muskan, but they could be other corporations or even another partnership that can create partnerships. The other important thing to remember about the definition is that this relationship exists for a purpose, and the purpose is to make a profit. If the relationship is not for this purpose, for the purpose of making profit, then it is not a partnership. Now, Kathy and Muskan want to know why they should choose partnership over other forms of business. Now, to which Brian explains a few advantages. Number one is that partnership is easily formed. There are very few government regulations that are applicable to partnership, so you can easily form them, and there are very few regulations as to reporting requirement for the partnership. Second important advantage for partnership is that partners bring to the business not only capital but skill and experiences and contacts as well. Um, Third advantage is that the risk, i.e., the losses, are spread across a larger number of people. Now, compared to a sole trader, if there is a loss that happens, it could wipe out the sole trader from the business. However, in a partnership, the risks and the losses are spread over a number of people, which makes it easy to absorb the losses in this case. And finally, there is a single taxation. Remember that partnerships, when they make profit, the profit of the partnership is not taxed. Rather, the individual partners are taxed on their share of profit from the partnership. Now, there are some disadvantages as well. Number one is that since the risk is spread over a larger number of individual, the profits should also be distributed over a larger number of people. So that's a disadvantage. A second disadvantage is that compared to sole proprietor or sole trader who owns and controls, who has a full control over the business, in a partnership, the control has to be shared with other partners. And finally, there could be disputes between partners. Now, the disputes can harm the partnership in a significant way and may even stop or cause the partnership to stop operating. So these are the disadvantages. Now, Kathy and Muskan would like to know a little more so that they can make their decision about partnership, whether they should continue as a partnership or not. So, Brian explained a few more important things. Number one is that the partnership acts as an entity, and so under legal rules, partnerships can own its own assets. The assets belong to the partnership rather than to the individual partners, and the partnership can sue and be sued. Under accounting rule, the partnership assets and transactions are kept separate from those of the partners. And finally, as explained earlier, as an advantage of partnership, the partnership isn't taxed on the profit, but the partners are taxed on their share of profits from partnership. Second thing to know, and this is an important thing to know, is that each partner can act on behalf of the partnership. Each partner can enter into transactions on behalf of the partnerships. They can buy and sell on behalf of the partnership. And when the partner makes that decision, then it will become binding on all other partners. So each partner has authority to make binding decisions on other partners. So if a partnership wants to limit the ability or authority of specific partners, they have to agree upon this, and then they have to make aware the third parties that there are limitations to the authorities of specific partners. And finally, the partnerships has an unlimited liability. That means that each partner is held personally responsible for all the debts of the partnership. Remember, if a partnership cannot pay its creditors, then the creditors can go after the personal assets of the partners. And even if a particular one particular partner cannot pay the debts, other partners have to share in the and pay for this specific partner as well. So there is this unlimited liability, and this unlimited liability makes it very unattractive a partnership as a form of business. Therefore, to avoid unlimited liability, some other forms of partnerships have been developed. So let's talk about those other forms of partnerships. Now, number one is the general partnership. Now, in general partnership, all partners have unlimited liability. All partners are general partners. That means that the creditors can go after the personal assets of any or all of the partners. The second type of partnership is a limited partnership. Here, one partner is a general partner who has unlimited liability, but other partners will have limited liabilities. And the third form of partnership is a limited liability for partnership. Here, partners are not personally liable for the partnership obligations. So the creditors cannot go after the personal assets of the partnership. If a partnership chooses to operate as a limited liability partnership, it has to mention LLP after its name, so that the public or those third parties interacting with the business are aware of this limited liability. Now, one of the disadvantages of partnership was the disputes or among partners. To avoid disputes among partners, the partners usually enter into a partnership agreement. Okay, that's an important thing. It has to be there so that the partnership avoids problems. Now, it's obviously not necessary, but it is very important to have a partnership so that the partners can work smoothly. So usually the partnership agreement contain things like the name of the partnership in partners, initial contribution, capital contribution of each partner, the rights and duties of each partners, the profit and loss sharing ratios, if they face disputes, how they can solve them, and some other aspects. So they can include as much they can include in the partnership agreement anything that the partners would want to put in this. There is no restriction. And it's a very good idea to have a partnership agreement so that each partner knows about their rights and duties, and how the operations of the partnerships will be managed. So this was the first video on the partnership agreement, partnership accounting. So watch other videos on this, and don't forget to like, subscribe, and hit the notification icon for more videos on to be aware of the more videos on the channel. So I will see you in the next video.